If you're thinking about buying a home, you need to know how to get pre-qualified for a mortgage. That way you can actually get the money to go out and buy a home. And there are 5 things that your bank is going to look at, or that your lender is going to look at when it comes to getting you pre-qualified. Number 1 is your income. Number 2 are your assets. Number 3 is your credit score. Number 4 is your debts. And number 5 is the type of loan that you want. Are you getting a conventional loan? Are you getting an FHA loan? Are you getting a jumbo loan? Are you getting a VA loan? Are you getting a USDA loan? We're going to go into each one of these 5 factors. Let me start by talking about number 1, which is taking a look at your income. This one is the most self-explanatory. Banks want to make sure that you have an income, and a stable income that's going to allow you to keep making the payments, because it's in the bank's best interest to make sure that they get paid. And so how do they do that? They want to see that you have a stable income. And what does that mean? That means generally they want to see at least 2 years of stable income, steady, ideally from the same employer. If it's not from the same employer, they don't want to see a bunch of moving around. That could be a big red flag for them. But they want to see 2 years of at least steady income coming in, where now you're getting paid and that you can afford the monthly payments. And in addition to that, if you are self-employed, if you are a business owner, you have your own business, you're an entrepreneur, they're going to still want to see those 2 years of steady employment, sometimes even a little bit longer. They try to be even more strict on entrepreneurs because they know that your income can be much more volatile than a steady paycheck. So they're going to be looking at how steady your income is. The second thing your bank is going to look at is your assets, because the bank now wants to play the game of what happens in the worst case scenario if you lose your job. Do you have assets that you can sell or liquidate that will allow you to continue making the payments? Because the bank wants to make sure they get paid whether you're getting paid or not. If you lose your job, that doesn't matter. The bank needs to make sure that they get paid. So what are they going to look at? They're going to look at things like your checking account and your savings accounts. They're going to see if you have any CDs. They're going to see if you own any stocks or if you own any bonds. They're going to see if you have a 401k or an IRA. They're going to see if you have any real estate investment holdings. And they're going to see if you have any other assets out there, because if something bad were to happen, if the economy goes down and you lose your job, your debt payments don't go away. The bank is not going to forgive them. And so they want to make sure that if something bad were to happen to your job, that you can sell off these assets and continue paying the bank, because the bank wants to make sure they're getting paid even if you're not getting paid. The third factor that your bank is going to look at is your credit score. Now, this one's interesting because the better your credit score, the less in fees that you're going to have to pay. Your credit score essentially tells the bank how qualified you are to make your payments on time. And if you are more qualified to make your payments on time, meaning you have a higher credit score, banks will generally reward you with a lower fee and a lower interest rate because you're less of a risk to the bank. You could think of it like when you go out to make an investment. If it's a super risky investment, like it's a gamble, you are going to expect higher potential returns. Yeah, you can lose money more likely, but your upside has to be a lot higher because you're making a bigger risk. Well, it's the same thing here. If the bank sees that you don't have a very good track record of paying things on time, they're going to have to justify that risk of investing money into you, meaning lending money to you, by taking on a higher return, by charging you a higher interest rate. So in general, if you want to get the best interest rates, the lowest mortgage rates possible, you want to have at least a credit score of 740 or higher. If you have a 740 credit score, that's going to open up the lowest and the best interest rates possible for you. But then some people are not going to have the 740 credit score. And the next question is, well, what are the minimum requirements that I need in order to qualify for a mortgage? And it's going to depend on what kind of mortgage that you get. So let's go over these based off of experience numbers. If you just want to get by and qualify for a conventional mortgage, you need a 620 credit score. If you want to get the jumbo mortgage, a larger mortgage, that's a 700 credit score. If you want an FHA mortgage and just get by, a 500 credit score can get you in the door. For the VA loan, a 620 credit score can get you in the door. And with a USDA credit score, a 580 credit score can get you in the door. If you're struggling with your credit score, there are ways and tricks and hacks that you can use to help raise your credit score quickly. I'm not going to go over all of them in this video. I've covered that on my channel. There's a bunch of resources on YouTube and on Google that you can learn about how to increase your credit score, and that will help you qualify for lower mortgage rates, which can save you a lot of money in the long term. The fourth factor that the bank is going to look at is debt, and more particularly DTI, which stands to debt to income. And what they're going to take a look at is how much debt are you paying out every single month relative to the amount of money that you're making. And then based off of that, they might qualify you for a mortgage based off of, well, how much income you have relative to how much debt that you have. The way that you can calculate your debt to income ratio is you take your total debt payments every single month, and then you add in your mortgage costs or your rental costs, and then you divide that by your gross monthly income, your pre-tax income, and that's going to give you your debt to income ratio. Here's an example of what that would look look like? Let's assume that your debts are very simple. You pay $400 a month for your car, you pay $100 a month for your credit card, and then you pay another $1,500 a month for your rent. That's a total monthly debt payment of $2,000 a month, and if you make $60,000 a year in salary pre-tax, that's $5,000 a month, you would do your total debt payments of $2,000 a month divided by your gross monthly income, which is $5,000 a month, which gives you a debt to income ratio of 40%. Now, if we go onto the Chase Bank's website, you'll see that what's considered a good debt to income ratio is 43%. You've heard me talk about this. A 43% debt to income ratio means that the banks are willing to lend you money generally up to 43% of the amount of money that you're making pre-tax. So if you don't have any other debts, you could in theory go out and spend 43% of your gross monthly income pre-tax on just your housing costs. Now, you don't need to be a financial genius to calculate that if you're spending 43% of your gross income pre-tax on your housing costs, and then you have to pay taxes, and then you have to pay for all of your other expenses, you're not really going to have much money left over to invest and save to build your wealth, which is why you don't want to blindly follow the bank's spend first guidelines, and instead you want to build your own guidelines, which force you to invest your money and save your money first, and then you spend whatever's left. And this brings me to the fifth factor, which is what type of loan are you trying to qualify for, because different loans are going to have different qualification rules. But before we get into that, if you have not joined Market Briefs yet, Market Briefs is a free resource that I created. It's a free newsletter where my team is working to break down what's happening in things like the housing market, the stock market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read email. You can read the email in less than 5 minutes every morning, and I'll give you a breakdown of all the things that you need to know what's happening in the financial news. So if you have not joined Market Briefs yet, it's completely free. You can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. There are 5 main general categories of loans that I'm going to talk about today. You have the conventional loans, you got the jumbo loans, you got the FHA loans, you got the VA loans, and then you got the USDA loans. Let's start by talking about the conventional loans. If you get a conventional loan, the general rule of thumb is that you're going to have to put down 20% as a down payment to get and qualify for a conventional loan. Now, does that mean you have to put down 20%? No, that's the general rule. You can put down a lower down payment, a significantly lower down payment, but because most conventional loans are not backed by the government, if you do not put down 20% as your down payment, you're going to have to pay an additional fee or fine called PMI, private mortgage insurance. And what that means now is if you put down a smaller down payment, let's say you only put down 10% to go out and buy a home. Well, if you put down 10%, you are a bigger risk to the bank of foreclosing, because if home values drop and you lose your job, well, you might be underwater on a home, and you might not have the same ability or interest to continue making your payments, which means you are a higher risk of foreclosure. Now, to protect the bank from a foreclosure and the cost of foreclosure, the bank will get insurance on you. But the insurance that the bank gets is paid by you, not the bank. That's what PMI is. So if you get a conventional loan and you're putting down less than 20%, you're going to have to pay for your mortgage, your property taxes, and then PMI on top of that. But once you hit that 20% equity, the PMI will generally go away. A jumbo loan is also pretty self-explanatory. If you want to borrow more money to go out and buy a home, you're going to get a jumbo loan. The size of the jumbo loan is going to depend on where you live, on what qualifies for a jumbo loan. Some areas are more than others because New York is much more expensive than, say, rural Idaho. But if you want to borrow more money, you're going to have to get a jumbo loan. Jumbo loans generally have higher down payment requirements and a little bit stricter on the credit score requirements, because if you're borrowing more money, banks want to make sure that you're a good investment. The third type of loan, and another very popular type of loan, are FHA loans. FHA loans are loans that are backed by the government. And because they're backed by the government, you have easier qualifications in order to get approved for an FHA loan, because if you were to default, your bank is not the one that's going to bear the burden of that. It's the government, because the government will put in the backstops and pretty much guarantee your loan. If you want to qualify for an FHA loan, you generally have a minimum down payment requirement of 3.5%. But you also have an insurance fee that you have to pay with FHA. But unlike a conventional loan, if you get an FHA loan, that insurance fee or payment that you have to make does not go away once you have 20% equity in your home. That insurance payment is going to stay for the life of your loan unless you refinance into a conventional loan. But generally speaking, that insurance payment will stay there for the life of your FHA loan. Then you have the VA loans. This is for current and former military members, The VA loans have a lot of special perks because you served in the military. One of them includes that you have the ability to have 0% down payment mortgages. Plus, you don't have to worry about paying PMI or anything like that. And they have a little bit of easier access in order to qualify for a mortgage. Plus, sometimes you can also get lower mortgage rates with a VA loan. And then you have the USDA loans, which was kind of an incentive created to encourage people to go out and buy homes in rural areas. And they're also there to help people in suburban areas who are very low income. So if you are low income in a suburban area, or you're looking to buy a home in a rural area, you can potentially qualify for a USDA loan. USDA loans also have that same benefit where you can potentially buy a home with a 0% down payment. So now you have a lot of different options out there. Talk to a smart mortgage broker to see what's the right option for you. The most important thing isn't what type of loan that you get. It is that you can afford your monthly payment. It's that you can afford the down payment and that you can afford the move-in costs. Because if you're going out and buying a home just to buy it, and are you sacrificing your ability to build wealth by investing your money and saving your money because you're living paycheck to paycheck just to make the monthly payments in your home, you're doing it the wrong way. The key to buying a home the right way is that you can buy a home that you can afford, that you can live in, and that's not going to sacrifice your ability to build wealth. CNBC put out a really good article titled "Financial Experts Share Their Greatest Money Regrets, and They All Have One Thing in Common." And I think this article really explains very well the money regrets that people have in their 30s. So I want to go over the 5 money regrets that CNBC talks about here because, well, I think these are really powerful ones. Let me start with number